Hey everybody, welcome to the Meet Damien channel here. We're about to do a live watch party here, looking at the Federal Reserve. They just lowered interest rates by 50 basis points. So they're going a bit aggressive here on the interest rate cuts. And we're currently waiting for Jerome Powell to show up on the podium, talk about why they actually went 50 basis points instead of 25 basis points. But we'll currently look at the Bitcoin here real quick, see what that did to the price of Bitcoin. And you can see right now that Bitcoin on the 1 hour chart here, Bitcoin's trading at $60,518, and we have we have a green candle here on the 1 hour. Bitcoin got up as high as $61,000 earlier, as soon as that news came out that they did a 50 basis point cut. It looks like it dropped down from 61,000 back to 60,500, but looks like Bitcoin is welcoming that with some positive price action here. We're still waiting for Jerome Powell to actually show up to the podium. I'll give you guys a quick look here at what I'm looking at right here. You can see that he is still not at the podium yet, but he usually shows up on time. It's currently 2:31 p.m. Eastern time here on the East Coast. Yeah, we'll go back and look at the charts. Talk about real quick here. Bitcoin is currently trading at $60,444, and I think Jerome just showed up to the podium, so we'll go ahead and actually try to listen to what he has to say here.
Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a 0.5 percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong third-quarter GDP running 3%.
A
So
little bit curious to
what
see
changed that
this,
made the
question
committee
has
go
to
50, and
relate
how do you
go with this
respond to the
question,
concerns
and we'll
that
summarize
perhaps it
this
shows
real
the
quick
Fed
here,
is more
guys.
concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions there. Let me jump in.
Yeah.
So since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So
Good question.
a couple things.
You're gonna get another 25 or a 50.
A good place to start is the SEP. But let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance
Meeting
of
by
risks.
meeting, data dependent.
If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEC.
As you guys can see here, Bitcoin is creeping back up again, going back up to 61,000. It's currently trading at 60,900. So I'm going to try to summarize this meeting here real quick, guys. Let me just turn the volume down here a little bit. So yeah, we basically had Jerome Powell just give his speech about why they decided to cut the interest rates by 50 basis points. They did say that Jerome Powell said that he's acknowledging that inflation is coming down, but it's still above their target rate of 2%. He also said that the Federal Reserve is still selling Treasury securities. So that in itself is, I believe that's quantitative tightening right there still. So a little bit interesting that they're still doing that. So they haven't done quantitative easing yet, which is I believe it should be them buying Treasury securities. So with them selling, that should cause interest rates to go up, even though they brought interest rates down with their 50 basis point cut. So it's a little bit conflicting. They're probably going to end that program soon, and then probably start quantitative easing when they start buying securities instead of selling them, which they're doing right now. So they're still offloading their balance sheet. That's still going on right now. It's a little bit conflicting. You lower interest rates, but then you're also selling Treasury securities still. So it's a little bit conflicting tidal waves going back and forth. They said that they're confident that inflation is coming down. So they do like that. Now that they're confident that inflation is coming down, it still hasn't come down to their target area of 2%. I think last time we looked at the inflation, it was like 2.9%. So it's in the two area, but not close enough. It's in the high twos. They're now more worried. Jerome Powell said that they're now more worried about the labor markets starting to become more of an issue. They're worried about the second side of their dual mandate, where they have to make sure that they get maximum employment. So they're worried that we might not get maximum employment if they keep interest rates restrictive as they have been doing that past year and a half now. We'll go back and just try to see if he's saying anything new here. He's taking questions right now from the reporters. We'll see if any new information can come from these questions here.
That the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year. All 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that. Now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example,
we're going to take it meeting by meeting. As I mentioned, we there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start. But and I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
So yeah, guys, basically, as far as more interest rate cuts, he's basically saying they're going to take it meeting by meeting. They're going to be data dependent. But it's nice to see that they're trying to send a message that they are concerned about unemployment rising and the labor markets not having their maximum employment that they would like to see. So it's, they're trying to stick what they call a soft landing. Where we basically get inflation down, and we basically get inflation down, and we have people still keep their jobs, and we get no recession, which has never happened. Even though they say they try to do this, they've been trying to do this for years now. It's never happened. Maybe Jerome Powell might be the first Federal Reserve chairman to actually stick a soft landing. But right now, people are worried about recession with unemployment going up, and including the Federal Reserve. They're worried about a recession, and that's why they decided to do a 50 basis point cut. And that has sent the markets up. The markets were celebrating that in the hours here. We'll look at the S&P 500 real quick here. You can see that looking at the S&P 500, we basically shot up to about 5,689. Now we're currently trading at 5,650. And I believe the markets they're digesting this information, trying to figure out, reading in between the lines of like what exactly the Federal Reserve is trying to do here. Are they actually worried about a recession? And I don't believe the Federal Reserve are too worried about a recession. The markets seem like they're handling it pretty well. Nothing too crazy. They did initially celebrate the news, but I think some people are worried that maybe the Federal Reserve knows a little bit more than what they're saying, and that things might actually be a little bit worse off. But there's so many traders out there opening and closing their positions. There's going to be a lot of volatility today and tomorrow as traders figure out, what exactly to make out of this news that we got from the Federal Reserve of them lowering 50 basis point cut in the markets here. We'll take a look at what's going on with gold here real quick. I believe gold should have been celebrating as well. And yeah, it looks like gold did celebrate here. We had the price of gold make a new all-time high of $2,600. We never seen gold at $2,600 an ounce, but that literally just happened today. And now gold is trading at $2,582 an ounce. So good luck buying your wedding rings there, guys, because you're going to be paying a pretty hefty price to to be buying gold right now. Maybe a good time to sell a wedding ring, or if you're a divorcee, to get rid of that wedding ring once and for all. If you have some bad memories of it, at least you can get paid to get rid of it. But yeah, gold has been, on a tear all throughout the summer months here, and it's still on this upward trend here. And who knows how high gold could possibly end up going. Some people saying it could possibly go up to like $3,000 an ounce. They just love those even numbers. It's a nice number to use in conversation here. But you can see that, even since like back in 2020, gold was trading at like $1,500 an ounce. Now we have gold trading at $2,500 an ounce. And it was trading sideways for the most part all throughout 2021 and 2022. And then we started getting some action towards the end of 2022, and it's been off to the races for gold. So, that's gold. I believe silver is doing the same. Silver is kind of like the sidekick over here, Batman and Robin. Gold being Batman, silver being Robin. Silver is trading at $30.66. Looks like it was celebrating the news as well. It didn't make a new all-time high like gold did. I have to zoom in here on the chart. Wow, a lot of indecision candles here on silver. Looks like the silver traders don't know what they want to do with any of this news. But just looking at the daily candle here, we did see silver get as high as $31.23. So not as high as what it was back here in I believe in May, where we got to like $32.49. But this might help silver catch a bid here for all you silver traders and investors out there. If they keep lowering interest rates, it only shows that there's still inflation out there, that the economy is not doing so well, and it's a good safety trade to be in. More people might get scared out of their minds to actually buy some silver coins. So that should help the silver investors there, silver prices. Let me just look at the hourly candle here, see what it did on the hourly here. Yeah, so yeah, there you go. There's the big news candle here. Silver shot up, like I said, $31.23, and now some of that optimism, enthusiasm is getting waning down a little bit as we find out why Jerome Powell and the Federal Reserve did what they did. But we'll just have to keep that. We'll have to keep watching the markets here, seeing what it does later on today, going into tomorrow and Friday. There should be more lively action going on here. But that's a pretty significant candle there for silver. We'll go ahead and actually take a look at some of these cryptos here. I know you guys like your cryptos. Keep in mind, guys, that this is a financial news channel here and education. I'm not a financial advisor, so please don't treat this as financial advice. You'll probably lose money if you listen to me. Just got to put that disclaimer out there. Because I don't know your personal situation and what your goals are. I'm not a financial advisor. I'm not your personal financial advisor. So please don't treat this as personal financial advice, because it's not personal financial advice. But anyways, we have Ethereum here at $2,340 here. And Ethereum also shot up because its opening candle was opening up at $2,300, and it shot up to like $2,362. So it was like in that news about the Federal Reserve interest rate cut there. But we have seen Ethereum at higher prices, especially around like Tuesday. We saw Ethereum get up to like $2,390. But I would like to see Ethereum get above that 200-day 200 moving average on the 1 hour candle here, to signify that we're back in the bull market here for Ethereum. And it was trying. It did peek its head above it, just like it did peek its head above it yesterday. But we want to see an actual close above the 200 moving average here, so we know that Ethereum is no longer in bearish territory, because that is basically what Ethereum has been doing for the most part here, for like the last, basically all throughout the summer here. So we want to see Ethereum get to higher prices here. And, in order for it to do that, we got to see Ethereum get above 23.39. That's all you got to do. Right. It's almost there, actually, on the 1 hour here. Yeah. If Ethereum could just close above at 23.40, we'll say, and just continue going to higher prices from there, that should flip the trend to be bullish again for Ethereum, at least on the 1 hour chart here. Yeah, let me see. Ethereum USD. Yeah, that's Ethereum here on using Coinbase data here. And like I said, Ethereum has been in a bear trend all throughout the summer. Can't get above the 200 moving average and stay there for too long. So that's your Ethereum right there, guys. We'll go ahead and take a look at Solana real quick. Solana USD. Let's see how Solana reacted to the news today. On the 1 hour, Solana is currently trading at $132. Let me get rid of this. Yeah. $132 Solana. And Solana, that got the green candle, got up to about $133. It opened at $129 on the hour. So we got a nice green candle, bullish engulfing, bullish candle here. Enough for it to get above the 21 exponential moving average, which is at $130. Enough for it to get above the 50 moving average, the green line there at $131.22. Looks like it got rejected off the 100 moving average at $132.73. And we haven't been able to get above the 200 moving average at $133. So it would have been nice to see Solana get above the $133, $134 level here. But we'll see as the day goes by here how the markets treat this news. You can see here on the RSI, we're not even overbought on the RSI, at least on the hourly time frame here. But looks like we're currently at a RSI level of 57.21 here on Solana. So if Solana decides to start to run up, it could do that without actually being overbought. So hopefully the markets react to this news positively going forward for the rest of the week, and we can see higher prices here for these cryptos and the stock market and gold and silver. We'll take a look at oil real quick here, see how the oil markets are doing and how they're treating this news. U.S. oil, WTI. Let's see. So we're now looking at the oil markets here. Oil is currently trading at $69.54. Looks like oil did get as high as about $70.28 on that news. But now it's digesting that information and it's deciding it's pretty much almost like a nothing burger, almost an indecision candle here. We've seen higher oil prices back in the summer here. And I believe oil is now contending with the fact that we might be going into recession, which is going to cause a lower demand for oil, lower demand from China, as those factories are no longer pumping out products like they used to. So, with that being said, oil, I think the oil market's more concerned about the demand side versus what interest rates are doing. But if they do lower interest rates, that does help oil, because oil is priced in dollars, and if they lower interest rates, that's going to hurt the dollar, cause the dollar to go down, and it's going to basically make the oil price go up because it's priced in dollars. A weaker dollar causes oil to be worth more, or at least it should cause oil to be going up in price, because the dollars are they're losing value when they lower interest rates. Let's see if let's check out the bond markets here real quick. We'll look at the TLT, see how TLT reacted to that news. This is the 20-year Treasury bond ETF on the stock market. And what did they do with that bit of news? Looks like they initially liked it, but they don't like it. Maybe they wanted more of a bigger interest rate cut. But yeah, I'm looking at the hourly candle here. TLT on the most recent hour here at like 2:30 East Coast time here. It got as high as $100.72. Now it's pushing down to $100, almost $100 even. So TLT is not really liking this news. I'm not sure why. It should cause the price of these bonds to go up because interest rates are going down. That's just the way things work normally. So yeah, we'll just end this here. We'll just end this on the Bitcoin price. See what Bitcoin is doing, because if the bond market's not really liking this interest rate cut, then maybe crypto doesn't like it either. But yeah, it looks like they're digesting this information. There might be. Let's see. Is the chairman still speaking? He is still speaking here. I might go back to him real quick before I end the stream here. But looks like on this new hourly candle here, we just started a new hour. It's 3:01 p.m. Eastern time here, and we're getting a small red candle here. Bitcoin currently trading at $60,400. So I believe that 60,500, 60,600 level is a point of contention that that Bitcoin needs to stay above if we're going to stay bullish on Bitcoin. But I do like the fact that Bitcoin is above most of the moving averages here. So we are in a bull trend for the most part, at least on the hourly time frame. Let's just take a look at the 4-hour time frame here real quick. And yeah, we're above the 4-hour moving averages here as well. So Bitcoin, like I said, if Bitcoin can stay above 60,500, 60,600, I think we'll see higher prices for Bitcoin going forward as the days and weeks go by here. Let's take a look at the Federal Reserve Chairman one more time before I end this live stream, see what he has to say.
And the labor market is
what exactly he's talking about, what
so
kind of questions
our
he's getting.
intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation. The goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. do you think you can return to 2% with housing inflation where it is?
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
The housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
So, guys, that's basically from the man himself, straight from the horse's mouth there. Federal Reserve Chairman Jerome Powell, he believes that inflation is coming down to 2%. That's why they're confident about lowering their interest rates to a more normal level is what they're calling it, because right now interest rates are at a restrictive level where they were trying to fight inflation, but now inflation is not really an issue anymore. He's not ready to declare victory on inflation. That's pretty smart of him. It's good. I think that's the right attitude to have. He's not ready to declare victory yet on inflation, but he is trying to help out the labor markets by reducing interest rates here. And he just talked about the stubborn inflation that they're getting in the housing market, but he acknowledges that that the Federal Reserve really can't have that much influence. He believes that with interest rates normalizing, that the housing market will also normalize as well. But he acknowledges that he doesn't really have that much influence on it. So he's not all too worried about that. They're more worried about unemployment going up than they are about the housing market. He believes that market rents and prices are where they should be at for the most part. Guys, this has been another live stream here on the Meet Damien channel. go ahead and click the like button if you got some good value out of this, and feel free to share this with your friends and family in the video. I try to talk about business and news as much as I can, and we look at the charts here, we look at the stocks. I do requests whenever you guys have requests. But yeah, this has been another video on the Meet Damien channel, and I'm not sure when I'll go live again. Sometimes I'll go live if there's some pretty important events coming up, like we had just now with the Federal Reserve. But I'm anticipating that there'll be another live stream next Tuesday afternoon or evening time on the East Coast time. So be on the lookout for that, guys. Yeah, I appreciate you guys coming out here on the live stream and taking a look at what's going on in the markets with me. All right, guys, take care.